Hello, everyone. I guess this is on. Hey, Elliot.
Hi.
Hi. Happy Tuesday there. And hi, everyone. Who I cannot see, but I know you are there. Our fellow CFA Boston members and friends. This is one of the career chat that we've been programming since a while ago. And today we're honored to have Elliott Garlock joining us for the topic, double your interview win rate by knowing the dirty secrets of recruiting. I do love that topic a lot. And I will give Elliott that credit for coming up with that title. But first thing first, just want to let everyone know this is a career chat, meaning that you have the opportunity to type your questions or responses in the chat box, and Elliott will be answering questions lively. But before going there, Elliott, why not share us about your background? What's your life journey about, and we can go further from there.
Okay, sure. Well, hello, everybody. My name is Elliott. I am speaking to you from old San Juan, Puerto Rico. I understand that most of you guys are in Boston. I live in Boston myself. And so I'm here with my two young kids and my wife and my parents and my brother and sister. I thought you might want to see what things look like out my window. That's the ocean, baby. And so if you hear any weird background noise, that is that is just the street of San Juan. I am going to bias towards answering people's questions in real time as we go through this. So I really would encourage you, if you are bored by what I'm saying, to ask questions that you want to hear the answers to. My sort of angle on today is to try to help you understand how the labor market works and how the recruiting industry works, and how you as an individual candidate in the market can interface inside that market ecosystem in a way that's more productive for you, to get you into the companies that you want to work at, into the jobs that you want, to increase your compensation over time, et cetera. And so I am going to try to sort of give you the sort of inside scoop on how different market participants work, what their incentives are, and how you can, through understanding those incentives, advocate for yourself in a way that's going to resonate with the market. If you want to look me up or learn more about me, this is the link to my LinkedIn account. You can really just type Elliott Garlock LinkedIn and it'll show up in Google. But I have an account there. I actually am a bit of a sort of amateur influencer on LinkedIn. So I make posts on LinkedIn maybe 3 or 4 times a week. And so if you like what I have to say today, you can endlessly hear what I have to say for the rest of your lives if you follow me on LinkedIn. And I also make TikTok videos. So on TikTok, I have a name called Web3 Daddy, where I talk about tech and recruiting. My daughter is about to learn how to talk very soon. And so one of the things we're going to start doing is having my daughter make memes about the venture capital ecosystem and cryptocurrency and different things, and have her play the role of a venture capitalist, saying Bitcoin to the moon and stuff. So that's a little bit about me. We did get some questions from the audience prior to this conversation, and I just created a big list of all the questions, and some of them were, hey, as a candidate, how do I get on a headhunter's radar? What should you not disclose to a headhunter? What role does a headhunter play between candidates and hiring managers? How to manage that tri-party relationship? This is my favorite question: how to distinguish a reputable and ethical headhunter from a dishonest one. I love that, because there are actually a lot of bad recruiters out there, and so I'm sure whoever asked that question has had one or more bad experiences, and I can try to unpack that a little bit for you so you can understand how to think about who you're dealing with. Then there are some more macro questions. What's the current state of the job market? Any subsectors that are hot? Any verticals in fintech? How to think about, functional roles and how they are related to compensation value in a company. And so I'll try to touch on all these things. But as I go, if other things pop out that look more interesting than any of these questions, we'll touch on those too. So if it sounds good to you, Bill, I can just dive into the first one.
Or before going to the first one, and Elliott, so firstly, I've been following your TikTok account for a while. There's some really, really good stuff there, and I love the name, Web3 Daddy. And I don't know, as one of your first followers, if I can, if I get access to your first token, so when that time comes. But first thing first, Elliott, would you mind like taking us to behind the curtain? How do you make money? How do headhunters like make money?
Great. So there's really 3 major types of recruiters that you might interface with, depending on the firm you're recruiting for. So the first category is an internal recruiter who is a salaried employee of the company that's recruiting for the role. And then the second category is an external recruiter, often sometimes referred to as a headhunter, sometimes referred to as an agency recruiter, sometimes referred to as an executive recruiter, sometimes referred to as a retained search associate. There's lots of different titles. And the thing to understand is that in that world, there are different pockets of people and they're paid differently and they're incentivized differently. And so, I assume many of you, when you were in college, you probably took a variety of economics courses. And so I was an econ major myself in college. And one of the things that I have found to be extremely true, even in my adult life, is that incentives matter a lot. And so if you can understand the incentive structure of someone that you're dealing with, it's going to be much easier for you to understand how they're likely going to treat you. So in the external recruiting world, there are really 2 types of search models. There's what's called retained search, and then there's what's called contingent search. In retained search, the client, who is the company that is hiring for the job, will hire a retained search firm. They will give that firm exclusive access to search for that role. So that firm is the only firm doing the role. And the company makes prepayments in advance before the role is filled. Generally, those payments are paid 30% of the fee on day 1, 30% of the fee on day 60, and then the balance of the fee at the completion of the search. Those search fees are typically 33% of the cash compensation of the role. And so if the role is paying $300,000 in cash, the search fee is $100,000. And when that search starts, the recruiter gets paid $30,000 before they do anything. And then on day 60, they get paid another $30,000 before it's even done. And then the final payment is paid at the end after the person signs. So when you're dealing with a retained search person, that is a person that is operating on traditional standards of professional conduct that you would expect from an attorney, from a management consultant, from an accountant, from other types of professional services, because it's a high touch, white glove, premium service. And that recruiter knows that they're definitely going to get paid. And there's not any channel competition with other recruiters in the market or with the company themselves that they are going to get that money. Oftentimes in retained search deals, even if the company identifies the candidate that they ultimately hire through a channel that is not that recruiter, the recruiter still gets paid 100% of their fee. And so retained search is a very high-end search model. And if you are a candidate and you are interacting with a retained search recruiter, you will probably know pretty quickly because they are going to impress you with knowledge and with professionalism. when a recruiter talks to you, a question you can ask them is you can just ask them, are you working on this on a retained basis? That is the language to say, are you working on this on a retained basis? Recruiters, if it's retained, they will tell you yes, out of the gate. And if they give you any answer that's a little bit weird, it means it's not retained. And if it's not retained, what it means is that it's contingent. So contingent recruiting is a very common style of recruiting, and it's also common in your industry, in financial services. The way contingent recruiting works is that the fee, first of all, is lower. So in retained search, it's typically 33% of the cash. In retained search, it can be as low as 15%, and it can be as high as 40%. But a very normal number is 20. And so, generally the contingent searches, they're for roles where the compensation is a little bit lower. So retained search usually starts around 250K cash salaries, where contingency, might be in salary ranges between, call it 80 and 250. Generally, once you go above 250 in cash, they generally start to switch into the retained model. Below 250, it's a little bit of a mix. So if a recruiter contacts you and they're a contingent recruiter, that can mean a lot of different things. They could have a great relationship with the client, and every candidate they submit to the client reviews, and it could be really serious. Or that client could have multiple contingent recruiters working on it, and that client may not have a particularly deep relationship with the client. So if you're talking to a recruiter and they're doing a contingent search, that doesn't mean that you shouldn't talk to them, by the way, but you just need to understand what you're dealing with. And with a contingent search, the way that business model works is the recruiter only gets paid if they get the placement done at the very end. So what that means is that the contingent recruiters, they're more, what's the right way to describe this? The way you as a candidate will experience it is they will seem junior, rude, brief, transactional, uninformed, sometimes unpleasant, generally not helpful. There are exceptions. There are some contingent recruiters out there who are wonderful people and who are great recruiters and run great businesses. But a lot of contingent recruiters, deserve their reputation. And so, and the thing about them is a lot of contingent recruiting businesses, if you're dealing with a recruiter that has you should always look the recruiter up on LinkedIn. And if they're have a small number of years of experience, say they've been recruiting for 12 months, 18 months, 24 months, that means they're a very junior person. And they probably are just they're training on the job. And so their interaction with you to some extent is kind of a training mechanism. If you're dealing with a more senior recruiter, let's say anyone that has, I don't know, maybe 5 to 7 years is kind of the break between a junior recruiter and a senior recruiter, then, they might be a little bit better, but they're going to be trying to really quickly qualify you in, qualify you out. And so if you feel that kind of way with the recruiter, that's what's going on there. The other thing is that the contingent recruiters, they earn a lot less money than the retained recruiters. So, not only is the fee, call it 20% of a 200K salary, so that's 40,000, but the recruiter that you're talking to, they don't get the full 40,000. They get between 20 and 40% of it, right? So they're making somewhere between 8 and 16,000 personally off of that placement. Where if you're talking to a retained search person, they're usually getting 50% or more of the fee. And so, they're getting 40 to 60,000 of the fee personally. So it's a very different world. So I don't know if this is too much detail for you guys to know, but it's very important to know who you're dealing with, because that will help you know how to interact with them. Looks like you wanted to say something, Bill.
No, I think this cannot be more important, because that also impact our experience as a candidate, and that drives the subsequent questions, how much we can really trust, and we believe we're, aligned with the recruiter facing the hiring manager or the employer, right? So just let's dwell on this important question a little bit. We have a question coming up in the chat box from Robert Muhal. So Elliott, you mentioned that there's kind of a threshold below which more likely you face contingent recruiters, and above which are more like a premium, retained search. So and that 250 grand cash comp threshold, is that a base or is that like a full package?
It's a little different by industry. So, one of the things that your audience should know is the thing that I know a lot about is venture capital backed technology companies, generally that sell software. So that's what I know a lot about. I know a little bit about financial services. I worked at Bridgewater Associates for a year. My wife works at Morgan Stanley. I, have a lot of friends who have done investment banking. I have friends who have done both on the M&A side and on the sales and trading side. For a year, I worked at a self-clearing brokerage startup company. So I probably know more about financial services than your average guy on the street, but I don't know nearly as much about financial services as I know about software. So in the software business, 250 is a pretty good number. Above 250, they generally go retained. In financial services, like Robert, I don't know if you can type into this thing. What kind of what kind of companies and jobs are you looking for? I can try to answer it more specifically. Like if you're like, let's say you're asset management. Okay. So like if you're on the asset management side and you're doing investing work and sometimes the salary, the cash comp in those roles is a lot higher than like what you'd see in a normal tech company. Cause 250 base and up in tech, that's high. Like most tech companies don't base people above 300 until they start becoming Series D pre-IPO companies or they're publicly traded. When you're in that like Series B, Series C stage, 300K is pretty high. But like, if you're like a portfolio manager inside of a hedge fund or something, those people are commonly making 600-700K, portfolio manager, like big portfolio managers are making $1 million plus. And so there's really a big range. I mean, even in asset management, there's a really big range. Okay, I see this question from Suzanne. I'll hit that in a second. I would say in the asset management business, there's more contingent recruiting that takes place in financial services. It's something that I've observed. And so, I can give you a name of a firm. There's a very well-known firm called Carrington Fox. So, some of you may know recruiters at Carrington Fox. A lot of Carrington Fox's business is retained, but even Carrington Fox will pick up contingency work. There's another firm you guys might know. It's called Options Group. Options Group does a ton of contingent recruiting. There's another one called Selby Jennings. Selby Jennings does a ton of contingency recruiting. So if you're getting a call from Options Group or Selby Jennings, pretty good chance you're dealing with a contingent recruiter. A slice of their business is retained though. Again, the best way to find out is to ask. There are cases where lower compensated roles are retained. The recruiter will tell you because most candidates don't know this information, so they don't know to ask. But if you ask them, they'll tell you. I'm going to give you some other tips on what to talk about with recruiters to get more value out of them as well. But let me answer Suzanne's question. Yep. Okay. Go. Do you want to say something, Bill?
Yeah, Suzanne has a question. What's the estimate comp for someone on a private company board or public company board? So this is different than, being like full-time.
Yeah. So the answer for Suzanne's question, so public company boards, actually the compensation's public. So you can go into the SEC 10K compensation report and you can just look it up because all external directors board compensation is publicly disclosed. Those numbers range widely. If you're on a really big like Fortune 100 board, those folks will commonly earn 300, 400, 500,000 a year in compensation to sit on the boards. If you look at venture capital backed companies, generally the board members are venture capital investors. And so they don't usually take compensation when the companies are private, but sometimes they do bring on external directors. Those roles, it's all over the board. Sometimes people do it for free just to have exposure to the network or to be in the club. Other times people will take some compensation, 50, 100K, sometimes 175K is not uncommon. But you generally see remunerated board seats a lot more in public companies or in like family private companies. Usually in venture capital companies, there's not as much remuneration. Private equity boards generally pay more. So if you look at like private equity backed companies, those board seats, I want to say it's like 100K a year, 150K a year, but there are people who earn less. There are also people who earn a lot more. It's all over the board on board comp.
Yeah, I mean, it's also like more heavy lifting, right, with the PE sponsored companies. Since this compensation, topic is getting really a lot of tractions. We have another question about comp. What would be the best way to handle if your recruiter ask you about your current compensation? Like, do people typically share those information with the hunter?
So here's a couple tips for dealing with the recruiters probably know your compensation within 20% anyway. And so when they're asking you that, part of what they're doing is they're just collecting market data so they can have a broader understanding of like what are the data points in the market that they recruit in. And then part of it is, I think, if they're a junior recruiter, then maybe they actually don't know. And so they're just trying to educate themselves. People are more one of the things I've learned, because I interview about 25 people a week, the good candidates always tell you what their compensation is. And it's usually the weaker candidates who don't. And so,
so that might signal confidence.
What's that?
That might signal confidence by just
it's actually not so much about confidence. It's about maturity as a professional and understanding how the game is played. So back to this question around the tri-party relationship between the recruiter, the company, and the candidate. Here's what the recruiter wants. Are you guys ready? They want the goddamn search to be over so they can get their money and move on to the next one. That is all they want. And the way that they get the money is that they find a candidate where there is candidate job fit, where their client will make the offer and make it done. And at the end of the day, what everybody wants to do is they want to drive up their effective hourly bill rate. So if you're a recruiter and you have a role and the fee is, let's say $100,000, let's say it's a retained search for a $300,000 job. And so there's a $100,000 fee. Do you want to talk to 50 candidates to get that job done? Or do you want to talk to 10 candidates? Because every candidate you meet, you have to do a 30-minute intro call, a 1-hour follow-up call, and then a couple hours of management through the process until they're done. So each candidate is a few hours of investment. So, 3 times 10 is 30, 3 times 50 is 150, right? So do you want to do that? Do you want to make 100 grand doing 30 hours of interviews or 100 hours of interviews? It's pretty obvious, right? And so if you find that a recruiter just ghosts you out of nowhere, that's a very strong indication that you were probably, at least in their judgment, not qualified for that job for some host of reasons. They might be wrong, they might be right, but that is at least what they're thinking because they're rational actors. The professional thing to do is to just tell the person that and close out the interaction. But a lot of recruiters are just jerks and they're busy, time is money, blah, blah, blah. And so they just kind of disappear. Sometimes it's just that they're busy and they kind of forget. Honestly, sometimes I kind of forget to tell candidates that they're not qualified, but sometimes they chase me down. Anytime they chase me down, I will call them and briefly tell them what's going on. I generally tell people what's going on, but when you're dealing with 25 new people a week, you can lose people sometimes, and that does happen.
Yeah.
And so, go on, Bill.
So it's like for you as a recruiter, you're optimizing your, uh, your income per time unit you're spending, right? So that
Exactly.
transparency from job candidates that actually can help you and in return, help the candidate, throughout this process.
Yeah.
So
The
that's
other thing is, the other reason why recruiters don't like to give candidates too much feedback is some candidates go apoplectic. Like you tell a candidate why they didn't pass an interview, and then they get mad, right? And then they start, and then also they don't want it in writing because then it exists forever, right? And or the candidate might send it to the client, and the client will be like, well, why did you tell the candidate this, right? So the other reason why recruiters sometimes ghost candidates or don't tell them what's going on is that they have a lot to lose but very little to gain, because some people can't handle feedback. So a few things to do if you're a candidate and you're dealing with a recruiter. Number one is, if the recruiter ghosts you, you can send them an email and say, hey, look, I realize, we kind of lost touch. I assume that your client doesn't think I'm a qualified candidate, and I could understand that. I myself would like to learn how I could be more attractive in the market. I would love any quick feedback you could provide. Don't worry, I'm not going to go nuts. I just want to learn. And I'd be happy to do a quick phone call. I'd be happy to get an email, whatever is most convenient for you. Leave your phone number in the email so that the recruiter could call you if they want to. Some of them will email you bullets. But if you just come out of your way and tell them that you're not one of those people that's going to go nuts, you will get more feedback from recruiters. But if the recruiter doesn't know the type of person you are, they're less likely to do it. Again, this breaks by retained search and contingency search. In retained search, the candidates are much fewer and more precious. And so there's a lot more interaction and feedback between retained candidates and retained professionals. In the contingent search, it's much more of a shit show.
So then how to get on the radar of the best, headhunters or the retained search headhunters?
Yeah.
How to kind of do the outreach to start with?
Yeah. So here is how recruiters find you. They go on LinkedIn, they type city, companies, job title, universities, years of graduation, they get a list and they message everybody, right? Generally speaking, if the reply rate on a recruiter campaign is about 25%, which means if you send 100 emails, 25 of those people will respond and say, thanks for the email, I'm interested, or thanks for the email, I'm not interested. 25% counts both. The interest rate is between 5 and 10%, which is they actually want to talk to you. So that means, you have to send 100 emails to get 8 people that want to talk to you. And half of those people are not qualified, right? Sometimes none of them are qualified. So here's another great tip. It's very hard to identify the good candidates who have high intent to change jobs on LinkedIn. So really good recruiters cultivate a network of candidates who surface other candidates for them. And so if you can make yourself an intelligence asset to a recruiter, it's very likely that as you help that recruiter, when that recruiter finally has a role that fits you, they're going to think about you for that search. So this is a little bit like I'm from Ohio, and so when I was raising up as a kid, my mom used to say all these things to me, like you catch more flies with honey. I don't know, I'm sure you guys have heard that phrase. This is true all the time. So if you really want a recruiter to help you land a job and get a 30% pay bump, sometimes the first step is to help that recruiter identify people that they're looking for. So a great thing to do is if a recruiter pitches you a job, and you yourself are either not interested in the job or not qualified for the job, or you're too senior for the job, but you can think of people that you know that would be good for it. You can say, hey, recruiter, here are 3 people that I think might be what you're looking for. Like, what do you think? And if they say, actually, yeah, that would be great, for you to then broker an introduction, that is extremely valuable to the recruiter, and very few people do it. And so if you become one of those people, they will not forget you. And the other thing you can do is check in with them from time to time. Hey, are you working on any searches? I myself am in the market, but if you're working on other searches, let me know what they are and what your criteria is. If I know anybody, I'll let you know. And then as you help that recruiter, they'll help you. The other thing is all the recruiters know each other, right? So like if someone comes to me and if I think the person is good, I might say, well, I don't have any clients that want to hire a person like this, but I know my recruiting buddy, Sally, works with those types of clients. And I know Sally is always looking for candidates like this. I'll send it over to Sally as professional courtesy. Makes me look good, right? Because maybe Sally down the line has a candidate that I'm looking for, right? And so as you start to actually become a real contact to a recruiter where they really know you, they can supercharge your network to other recruiters to get you on the radar, but they're not going to do it if they don't know you. And the way for them to know you is for you to help them. Because keep in mind, recruiters' jobs is to get people hired. That's it. And so if you can help them do that, then they are going to be much more motivated to help you.
Yeah, it's kind of a help you, help me, help you, help me situation, right?
Exactly.
It's not like just like a one-time transaction. It sounds like more iterative and more expansive than just you as a candidate. It's also like about like letting the recruiter into your network, so that when you have the need down the road, you get like immediate attention and help. So and still like what to share, like, or what not to share with recruiters. You can share your compensation, you can share your network, but how about other things? Like we have a question in the chat box. How about like disability or other more personal dynamics, or even professional dynamics? Like, is there any kind of a playbook, what to share, what not to share?
Yeah. So one of the things about recruiting is that one of the big thing that recruiting is about disqualification. So if you're a candidate, when you're in the very beginnings of an interaction with a recruiter, of course you want to be candid, and of course you want to tell them information, but you don't want to unnecessarily disqualify yourself. So there was a question in here about disability. So the United States has laws about this. Disability is a protected class. Employers are not permitted to discriminate people who have disabilities. But I think anybody who lives in America knows that our society, for all of its wonderful qualities, is also very flawed. And there is a lot of systematic discrimination, racism, sexism, ageism that takes place in our society, in our workplace. And even with laws on the books to protect against this, it still happens. And so, as it relates to disability, that is not really something I would recommend you bring up until you're very mature into a recruiting process, because the labor market is very big. And so you don't want to give recruiters or their clients reasons to say, well, this is going to be a little bit more friction. So like, why don't we just try to find 7 more people, right? So with disability, I think the most practical thing to do is, assuming that you don't think your disability gets in the way of you performing your job function, then it really isn't relevant at the beginning of a recruiting process. And I would, see no point in really disclosing that. Now, if at some point there are accommodations that need to be made, and knowing whether or not you have access to those accommodations is contingent on whether that's a place you want to work. Towards the later stages of the interview process, that would be a better place to introduce that.
Yeah, that's right. That's also like a later stage when you have developed some deeper bonding with the hiring manager, right? So that's also the process where offers and the contingencies are being considered, and where you can comfortably share more, for arrangement or accommodation. And by the way, by that stage, employers are more on the hook for denying you the job opportunity for reasons like a disability and such, versus the earlier the stage, it's a like less easy to defend yourself that way. I don't know if that's the right impression.
Can you condense the question a bit, Bill?
The question is for some of the more personal, hardships, maybe, because like at a later stage, it's more difficult for employers to not accommodate. Would you say so? Like, disability, one thing, and I know some folks also face, immigration, sponsorship, and sometimes even like a location and, remote work conditions and such. So
Yeah.
Is that like any, aside from like, disability, immigration status, location, like any other, disclosures that you yourself see, that's, people like really like, better disclose like later or even not disclose?
I think I understand what you're saying. Let me, I'll answer a different question, but I think touches on this. The thing for people to appreciate is that companies don't hire candidates. Individuals inside of companies hire individual candidates. And so the recruiting process is one about human connection. And so if you are a candidate and you go through a recruiting process in which you meet several individuals at a company, and the majority of those individuals want you to be hired at that company, it's likely going to happen. And if at some point as you're going through, you say, oh, by the way, I had polio when I was a kid, and so I'm paralyzed from the waist down, and I ride around in a wheelchair. At that point, they're like, well, you don't need to walk to do this job. So, I mean, we have an elevator in our building, and so we don't really care. That's like not material at all to this process. And we've interviewed you and we like you and we want you on our team and we know you can do the job. And so thanks for letting us know, but not all that relevant, right? And you'll probably move through. So every one of these things is a little bit idiosyncratic. I think every disability is a little bit different. As you start looking at immigration status and these different things are all different. You're dealing with different people. A lot of times recruiters will sometimes screen those candidates out, even if the clients don't ask them to, because recruiters get paid very high fees to get people hired. And so they are trying to provide choices to the clients that are extremely easy for the clients to make. So they're trying to reduce any possible friction points at all. And so you as a candidate, you want to decrease friction as much as possible up until the point that you've actually developed real relationships with the people, because any potential idiosyncrasies that you have around you as a person, those things become way less of a big deal when they're attached to you as an individual rather than in the abstract. Because when you're in the abstract, you're still in a really big funnel. So the thing is, well, we're paying the recruiter a lot of money, just find more people. That's the perspective in the very beginning. Towards the end, they're like, well, we really like Jessica, so let's just get Jessica hired. And so the thing is recruiting moves through this process of find qualified people, try very hard to disqualify them. If you can't disqualify them, try very hard to get them to sign the offer. And so recruiting has this schizophrenic quality to it, where people are very nice in the beginning, very aggressive, probing, and unpleasant in the middle, and then very nice and accommodating at the end, right? And that's how every recruiting cycle works. And so to understand that natural flow is very important. And so in the very beginning, you as a candidate want to be very accommodating to them. So you
decrease the friction. Yeah.
And then towards the end, you don't have to be as accommodating because they've already invested all these resources to try to get you hired. And they've already met a bunch of other people that they don't want. And they don't want to go through the work of trying to find yet another person. And then you become the asset that needs to get closed. So you need to modulate the information you disclose as you move through that thing. Compensation is not as sensitive as people think, because as a recruiter, all I ever talk about with people is their goddamn compensation, right? So when it's boring for me to talk about people's compensation because I'm talking about it all the time. For you guys, you're, financial service professionals. And so you don't talk about it all the time like I do. And so it feels more sensitive to you. But when you're dealing with recruiters, like, if I'm recruiting for a job and the budget for the job is 200,000 and you're making 300, I mean, there's nothing to talk about here, right?
Can we ask like that right away, like from the get-go? Can we ask that, hey, what's your budget? Like, or like I'm waiting for a budget.
Okay, this comes up all the time in recruiting. Clients always have a very broad range for what they're willing to pay for a role. And so, because there's different kinds of people you could hire. You could hire a kind of a rising up and comer where they're going in the job as a step up. And so that person's going to be paid a little bit less to do the same job. Or you can hire like a tried and tested person who's done the job already and they're coming into a lateral move, doing the same job, but they're coming from a different place. That different person in the same job will be paid more. And so the client doesn't necessarily know which one of those they want to hire. They want to meet people and get a feel for it, right? And so also, it's not their money. Like if they're working at some big company, it's not their money that they're paying the compensation budget out of. So whether they end up paying the person 150 or 275, they don't actually care that much oftentimes. And this is especially true in tech. Sometimes like in financial services, especially if you're in a money management position where you have like AUM and you deploy the AUM, and then there's like the returns and the revenue, and then you're like splitting a bonus pool. Like if you're in a business where a bonus pool is being split across 4 or 5 people, if you hire a more senior person, that just means more of the bonus pool goes to them and less to the other people. And so there's always kind of pressure to like hire more junior people so the senior people can get more money. So understanding the structure that you're in is pretty important because that will determine what they're motivated for on a comp side. But the reason why comp is always really broad is because there's different levels they could hire for, and the role might change a little bit based on who they hire, but that's how they think about it. But for the most part, most big companies have pretty standard comp bands. Experienced recruiters kind of know those bands. Whether you're an L4 or an L5, the recruiter may not know exactly. And so maybe they're just trying to figure out, okay, is this like a 225 person or a 260 person? Like they may not know that. And all things considered, to just tell them you're not giving away, you don't have to change jobs if you don't want to, right? Most people, when they change jobs, they change for a 20 to 60% comp increase. That's the range I've seen. If you're leaving a job and you're not getting at least a 15% comp increase, you're a sucker. Like that's one thing I'll tell everybody on the call right now. Do not change unless your boss is a psycho, or unless you're just totally miserable at your company, or if you just know you're going to be getting fired from your job And so it's just a question of, are you going to quit and get a job somewhere else, or are they going to fire you? Maybe in those conditions, you don't leave for a big comp change. But if you are like in good status at your company, your boss likes you, you're doing an above average job, you should not be leaving for less than 15% of a comp increase. And, I know people who sometimes get really big increases when they change. It also, these things also kind of are tailored to like, the sector you're in, the level you're at, like what cities you're in. So I just saw a question, like, does the 15% include living cost adjustment? So yeah, like if you're in Boston and you're moving to New York City, you should be getting paid a lot more money to live in New York City. Like New York is a lot more expensive than Boston, right?
Yeah, I've heard people say like double at least, to make it.
And so like to answer the question I just saw here, yeah, like that 15% number, that's like assuming you're staying in the same market and you're just moving to a different company and a different job. And that's the general expectation that employers have. Like when they're hiring experienced external people, they're expecting you to be getting a pay increase. And so
don't short sell yourself. The range can be really wide. And if you're moving, for financial reasons, better make it, worth the effort, right? And
the other thing that you can do, like the other tip that I would give people is the recruiters you're talking to have a lot of comp data in their head. So if they ask you your comp information, one of the things you can say is, hey, listen, I'll tell you, but in exchange, I'd like you to tell me what you're seeing in the market, right? And then you're turning the relationship you're turning it into a bi-directional relationship where you're both exchanging information with one another. Because as you add value to that recruiter's knowledge, they'll be like, oh, wow, like very few people do this. I'll give this person a little bit more information. That's the kind of relationship you want with them.
Since we love this compensation financial topic as financial professionals, let's picture ourselves like in 5 years, 2028. And Elliott, where do you see the verticals of the economy that are of the highest pay potential, be it like a job function, or be it like a specific skill that is really like trending up in job market?
Okay, so here's a great way of thinking about it. The companies that pay the most are the companies that can afford it. And the best way to understand what a company can afford is to understand what its profit economics are and what its market is. So I'll give you a really great example. Let's look at Microsoft or Google as an example. Their business is they sell extremely high margin software products. The incremental cost of selling an additional unit of Microsoft Office is virtually zero. The incremental cost of 5 billion searches a day or 6 billion searches a day is processing power, but it's pretty minimal, right? If you're Amazon or Wayfair and you're in the e-commerce business, every time you sell a unit, that unit has cost of goods sold and it has a fulfillment cost, right? And so those businesses, as they scale, as they incrementally grow their revenue, they're also incrementally growing their cost structure. So one of the reasons, of course, we're in a major tech economic reset right now, right? Market caps for the tech companies are down significantly. Revenue growth rates for those companies are down. Revenue and EBITDA multiple valuation stats for those companies are all down. I mean, this is a real bad time for the tech industry, all things considered. It'll probably come back within the next 18 months. It won't be like it was in 2021 for a long time, maybe ever. 2021 was pretty crazy. But you should look at the business and just ask yourself, like, how big of a market is this company in? And every time they generate $1 of revenue, how much of that dollar do they keep? The companies that pay the best are the ones that have high gross margins, that are in big markets, that grow fast. So the best thing to do is to be in a company that has all three. Google and Microsoft are great examples of that. Amazon, at least their retail business, doesn't have great gross margins, but it's a gigantic market with super high growth rates. So Amazon has been a very compelling payer for a long time because it's just gigantic market, right? If you start looking at more niche things like let's say like an enterprise software company, like look at Zoom, you know, the app we're using right now to do this video call. Incremental cost of bringing on new users is small because all they're selling are these Zoom licenses, right? But the market for Zoom is smaller than the US retail market, right? And so Zoom can't ever become as big as Amazon, but for every dollar that Zoom makes, they keep a lot more than Amazon, but it's in a smaller market. So you have to kind of go through these common sense things. Like when you're joining a company, don't just think about your area of expertise and the job you're doing and where you are in the org chart. You need to think about it the way Warren Buffett and other macro and value-based investors think about companies. Like, is this a company that is really good at growing its value? If so, that's probably going to be a good place to work. And it's probably going to be a place that's going to pay better. Even when you look in the financial services businesses, right? You know, hedge funds that operate on a 2 and 20 model, right? You know, generally pay a lot better than like custodian based businesses that charge small transaction fees on huge dollars. And so looking at the business model is a great indication of like what the thing is to pay. So, you know, right now, like our economy is in a bit of a weird reset, but when we come out of this, there are going to be things that are always universal. Big market is always universal. High gross margin is always universal. So the advice I always give people is, all things being equal, the best lever is a high gross margin business, because those businesses are going to have more money to spend on their staff.
Within the kind of intersection of financial services and technology, because that's where your business is more active in, where are the like verticals or even name of companies that, you know, check off those two boxes: big market and high gross margin? I mean, there's like a blockchain, there's like a insurance tech, there's like a modern banking, lending.
Yeah, so I'll give you there's a lot of discussion right now around a lot of the neobanks. So, you know, like if you like Google neobank company valuation, there's a bunch of criticisms of neobanks right now. Because what people say is, okay, I mean, basically, this is a company that developed a partnership with the bank, got a Visa card, put their own logo on it, created a user interface and an iPhone app, and they're giving away things and they're only making money off interchange fees. Thing was valued at 80x revenue. How can this persist? So probably the neobank category, the last few years, they were good payers because they were growing their market caps like crazy because VCs were dumping money into it and they had all this VC capital to spend and they were kind of growing off that. Going forward, neobanks, it's kind of a race to the bottom business. So, you know, a neobank, probably not great, it'd be my guess. Now, like, let's look at another business like Stripe, which is a very well-known fintech company.
Payment.
You know, they are just extremely dominant in the payment services that they provide over the internet. And so they will probably continue to be a great payer because they have built a very dominant business, and there's pockets of their business that are pretty high margin, but they just kill it and they don't really have any significant competition. So Stripe is probably a good one. Let me think of other like specific companies.
Is blockchain dead? Blockchain.
I don't know. You know, I had a lot of crypto clients before Luna collapsed in May. And there's a lot there, you know, there was a lot of funding that went into crypto companies, and most of them haven't spent all their money yet. And so a lot of them still have another 30, 40 million to spend. The whole value of blockchain, it all just ties back to the consumer. If consumers want to keep using blockchain services, and they increasingly use it, and they use it with bigger transactions with more frequency, it's going to take off and become really big. If consumers don't use it, it's not going to go anywhere. Future of it, I really don't know. If I knew, I wouldn't be a dumb recruiter, doing fee for placement recruiting services. I'd be, really rich.
How about brokerage and clearing?
Yeah.
I mean, so you were like an in-house recruiter, right? At a
Yeah.
brokerage.
I think those businesses are pretty good. Like I used to work at a business called Clear Street, which is a mid-stage startup company that is a self-clearing brokerage business. And I think that business is going to be quite successful. And I know everyone who works there, and I know what they're doing, and I know who their competitors are. That business, it's not extremely high margin, but it's a very large market. And it's a market that has very well understood profit economics. And it's a market where really big players like Credit Suisse and other big banks are retreating from the market and giving up market share. And so new entrants are taking that market and doing well with it. So, that company I think will do very well. It's hard for me to kind of come up with companies like right off the top of my head. I mean, any enterprise software company. I mean, enterprise software companies are all struggling right now because they all bought software from one another. And so as that whole market is slowing down, the incestuousness of that industry is starting to go away. And so now they have to rely on selling their software to others. But I think long-term, companies like Zoom, like Slack, like Microsoft, they're always going to be great. Any new entry software company that has a really good product market fit, I think those are always going to be high gross margin businesses. And then the question on those companies is their market big enough?
Yeah,
that's always the question. Because there's a lot of enterprise software companies that can go to 20 million in revenue or 50 million in revenue. Most of them don't have markets big enough to do 200, 300, 400 million in revenue, $1 billion in revenue. That's a little bit more niche, but that doesn't mean you can't be paid very well, because it's really the gross margin that dictates how much the business can afford to pay people.
Elliott, we have two questions, maybe for the last 2 minutes. One question related to location. Are companies still offering hybrid, or is that changing? The other question is, it seems that small firms pay better compared to larger firms. Is that true? So one is about location, flexibility. The other one is about, company size, small versus large. Does smaller pay better?
So the location thing, that's all over the map. It's different by industry. It's different by company maturity. It's idiosyncratic to who the leadership of the company is. Broadly speaking, I feel like there's a major push back to the in-office dominant work, I think is what I'm observing, just talking to my own clients. And when I talk to people on the phone, a lot of times I'm on the phone with candidates and they're like, well, my company wants me back in the office 3-4 days a week, and I don't want to do that. So I'm looking for a company where I don't have to do that. And I'm like, all right, well, that's not what I got. Good luck out there. So I'm definitely hearing there's a lot of folks in the candidate market that want to maintain permanent remote or dominant remote work, but I'm talking to a lot more companies that want in-office dominant work with a little bit more flexibility than what was normal before. As we move into a recession, the labor market is still quite hot even right now, but it is gradually cooling. It's much cooler in the tech economy than it is in the broader economy. And so the tech companies are all kind of following Elon Musk's trailblazing shit that he's been doing at Twitter for the last 2 months. And there's a lot of chatter in the CEO Twitter, they all want to copy what Elon Musk is doing, and it's happening a lot more. So I think in the software business, I think in office is going to be much more dominant than what a lot of people think. The other thing is the people I have 2 young kids. And so I love working from my home office, but if I were 24 years old and single, I'd probably like to go to an office 4 days a week, to be honest. If I was living in a small apartment and stuff, or if I was in a big company and I was a big boss at a big company, you know, I'd want to see all the people that work for me that I boss around all the time so I could feel good about myself. And so, like, there is this slice of people that I would say are in mid-30s with young kids who really, really like the remote work thing. But like the big bosses and all the rising up and comers, I think a lot of them actually really prefer the in-office work. And so you can always find companies that want remote work, probably not in financial services. Like of all the industries, financial services is the one that's going hardest back to the office. And so I think financial services especially is going to be really strong in office. It kind of already is right now. And I think it's going to go even further over the next year or two.
Yeah, definitely. It's industry specific, company specific, and individual needs specific. And thank you so much, Elliott, for your time, and thank you for the candid sharing of the dirty secrets, within the recruiting industry, the incentives, and the dynamics between the involved parties. This is super, super valuable. Thank you so much.
You're welcome, Bill. Thanks, everybody.
And everybody, you can find Elliott Garlock on LinkedIn by typing Elliott Garlock or Web3 Daddy on TikTok. Yes, this guy's on TikTok, and he's getting some likes, increased likes. All right, thank you, everyone. Thank you for your time. Hope you are getting something out of this, and we'll see you next time.